Hello, everyone. Welcome to Edgemoor Investment Advisors' second quarter 2021 presentation on current market conditions and outlook. I'm Gay Truscott, and I'm joined today by my colleague Tim Coughlin. We are pleased to be back making this presentation for our clients and friends. We are also pleased to announce that Edgemoor's office reopened as of June 1st. We all worked well from home for 15 months during the pandemic, but we are happy to be back together in our office in Bethesda. We welcome all clients who would like to return to in-person meetings to give us a call and set up an appointment to come in. Our agenda for today will follow the quarterly newsletter, which went out last week and is also posted on our website and blog. I will discuss the great reemergence of our economy and financial markets, which accelerated in the second quarter. Tim will give our outlook on everything from inflation to interest rates, and then I will conclude with a few closing remarks. We encourage your feedback on this presentation, as well as any ideas you may have for other presentations, so please feel free to call or email us with your thoughts. The U.S. economy and financial markets accelerated their recovery in the second quarter of 2021 from the COVID-19 pandemic that kept Americans and the world in its grip for more than 15 months. Several factors have contributed to this robust recovery. First, increasing vaccination rates in most parts of the U.S. have led to the easing of pandemic-related restrictions, which in turn have boosted economic activity and consumer spending. You can see on this slide that as of July, 66.8% of the U.S. adult population has received at least one COVID-19 vaccine, and nearly 58% are fully vaccinated. As Tim will discuss in more detail, the other factors contributing to the robust recovery are the Federal Reserve's ongoing commitment to low interest rates and accommodative monetary policies, which have spurred everything from home purchases to corporate investment. In addition, government stimulus may continue with a bipartisan infrastructure spending program now working its way through Congress. All of these factors have contributed to an economic recovery that has been faster and stronger than many expected. In fact, the Fed keeps revising upward its estimate for 2021 GDP growth from just 4.2% back in December to 6.4% in March and 7% by mid-June. Some economists are even more bullish, predicting that GDP could grow at an annualized rate of 8 to 9% this year. This slide shows that quarterly GDP has continued the rebound that began in the latter half of 2020, posting 6.4% growth in the first quarter of 2021 and likely accelerating to 7.6% in the second quarter that ended June 30th. The strong uptick in economic activity has led to a robust rebound in corporate earnings, which increased 143% in the first quarter of 2021 from the pandemic low point of the first quarter of 2020. This chart shows that for the full year, S&P 500 earnings are projected to grow 36% to $191 per share from $140 in 2020, and then grow another 11% in 2022 to just over $213 per share. All of these factors have fueled stock market gains of 15.3% for the S&P 500 in the first half of 2021 ended June 30th, with most stock indices reaching record highs by the end of the quarter. As this slide shows, not only has the S&P 500 recovered from its pandemic low point of 2237 in March 2020, but it has regained those losses and more over the last 15 months to reach nearly 4,300 on June 30th and just over 4,400 as of close of business yesterday. Finally, the employment picture has also brightened considerably in 2021. After a blockbuster employment report in March, job growth slowed slightly in April, but recovered in May and June, sending the unemployment rate down to 5.9% from a high point of 14.8% during the pandemic. In a frustrating twist to employers, however, job postings are at record levels, even as 9 million Americans remain unemployed. We do expect this labor market dislocation to ease in the coming months, as most supplemental unemployment benefits expire in September, meaning more workers will be incentivized to return to the workforce. Now I will turn it over to Tim Coughlin to talk about our outlook for the economy and financial markets.
Thank you, Gay. Looking ahead, I would like to emphasize our outlook for continued positive developments in the U.S. economy and its financial markets for the factors you mentioned: increasing vaccinations, the Federal Reserve's commitment to low interest rates, and government fiscal stimulus. As the U.S. economy continues to come back from the depths of the pandemic, many investors now see inflation as the next serious risk to the economy and financial markets. Stoking this fear, consumer prices rose to an annualized rate of 5.4% in June, marking a 13-year high. However, the Fed has remarked that the current burst of inflation, seen especially in rising commodity, energy, and other raw material prices, is likely to be transitory, lasting only until global supply chains recover and the supply-demand relationship for most goods and services comes more into balance. Fears of inflation have also put the spotlight on interest rates, specifically how and when the Fed might respond by raising rates and curtailing U.S. government and mortgage-backed bond purchases. Given its view that the current inflationary pressures are transitory, the Fed has not indicated any material change in its monetary policy, meaning that it does not expect any rate hikes to be needed until 2023. Importantly, the Federal Reserve Bank, led by Chairman Jerome Powell, is data-driven and, in our opinion, will be able to deal effectively with the delicate balance between its two mandates for full employment and low inflation rates as circumstances warrant. We think Powell has done and will continue to do an outstanding job. We remain optimistic that the U.S. economy and financial markets will continue their positive trajectory through 2021 and into 2022, as businesses and consumers continue to recover from the coronavirus pandemic. Overall, the combination of pent-up consumer demand, supportive monetary and fiscal policies, improving business and consumer confidence, and reopening momentum provide a favorable backdrop for continued growth in the U.S. economy and financial markets. Stocks should perform well in this environment. Having said this, we would not be surprised to see an increased stock market volatility as investors remain skittish about buoyant asset values and continue to parse every word by Chairman Powell. Gay, back to you.
Thank you, Tim. With regard to portfolio implications, we do not anticipate any major changes to our portfolio as a result of current trends. We continue to construct well-diversified portfolios for our clients that are designed to weather the ups and downs in the market. We also hold and are looking for more attractively priced investments that might benefit from infrastructure spending and the broader economic recovery. As long-term investors, our philosophy is to focus on the fundamental analysis of companies' earnings, growth potential, and balance sheet strength. The 3 stocks we featured in our quarterly report that exhibit these fundamentals, namely General Dynamics, Merck, and Blackstone Mortgage Trust. For the income portion of our client portfolios, we also continue to buy both traditional bonds and other non-fixed rate securities like preferred stocks, REITs, and utilities with a history of increasing their payouts over time. So that concludes our presentation for today. We hope you found it useful and informative. Again, we appreciate your feedback on this presentation and any other topics you think would be of interest. We hope that everyone is staying healthy and well, and we look forward to connecting with you again next quarter.